Right friends, welcome back to Learning Space. This is the revision series of current affairs. This is the 18th module and this is economy module number 4, overall revision module, module number 18. Let us look at some important events. Recently in the news item, an article appeared with regard to the gold reserves. Right, have a glance at this slide. Here the United States of America that is having the highest gold reserves, and if you see as the percentage of foreign exchange reserves, please do not forget countries like USA, Germany, Italy, France, they invest more as percentage of gold reserves when one looks at foreign exchange reserves. That means when one looks at overall foreign exchange reserves, the countries like USA, Germany, Italy, France, they invest more in gold. In fact, for these countries, gold reserves as percentage of foreign exchange reserves are more than 60%, right? And when you look at country like India, that is 6.4%. So friends, our gold reserves are around 600 tons, and when you calculate as percentage of the foreign exchange reserves, they constitute just around 6%. And please don't forget, when one looks at foreign exchange reserves for the country, the majority are in foreign currency assets. Very important. Majority of our foreign exchange reserves are invested in the foreign currency assets, right? And around 6% as gold reserves, right? But for the advanced countries, it is much higher, right? For USA, the highest percentage, that is 75% in gold as far as total foreign exchange reserves are concerned. And please do not forget, India's position is 11th. If you club IMF also, IMF holds around 2,800 tons of gold reserves. And 3-4 important points why gold reserves are required. Before understanding this, let us have a glance at India's purchase of the gold, or you can say at present it is close to 600 tons. That is the important aspect. And second most important aspect is globally. Please understand this statement also. Globally, gold purchases by central banks were at their highest level in 50 years. That means if you take the past 50 years, the gold purchases by the central banks at the highest level in 2018, that is the highest in 50 years, right? Have a look at it. And about India, it is around 600 tons and it is 6.4% of foreign exchange reserves. And these are the points why gold is being purchased. Or you can say why gold is an asset under the foreign exchange reserves. There are a number of reasons for it. The first and the foremost is it increases the country's standing in the global arena. That is one aspect. Second is to diversify the foreign exchange reserves, right? You cannot keep everything as a dollar or some other hard currency. But what is important is diversification of foreign exchange reserves. That is the first one. Second one is gold is a finite asset. And if you look at your currency note, in fact, the currency note value depends upon the market price. But gold is considered to be relatively stable. And the gold price volatility is relatively less in comparison to other commodities. And one more important point is the price volatility with regard to the supply and demand, that is also less. Because of all these reasons, gold is taken as one of the element of foreign exchange reserves for the countries. I hope you got the point. And after that, here have a glance at it. And in fact, this is about central banks hoarding of gold reserves, right? During the past decade or so, it is on continuous increase. And one more important aspect is here Russia and China, they purchased the highest gold during the past decade. These statistics may not be that important, but one important point one should not miss. Some countries are purchasing more gold, especially countries like Russia, basically to reduce their dependence on dollar. right? So that is one reason why Russia is purchasing huge gold, basically to reduce the dependence on dollar, right? And in recent times, countries like Poland, Hungary, they are also purchasing huge gold, right friends? This is more than enough. We discussed for around 3-4 minutes on this, and look at this. I have taken once again. Some students raised doubts with regard to angel tax. Right friends, now angel tax regulations are highly liberalized, and please don't forget, this is pertaining to startups, and startups has got huge growth potential, and this I am repeating because some students asked some doubts with regard to angel tax. This I am repeating for 3-4 minutes, right? So here angel tax mechanism is basically, this is for the startups, and startups means here up to 10 years, previously after the registration 7 years, but now it is increased to 10 years, and during this period the turnover of the startup should not exceed rupees 100 crore. This is the second condition, and let us come back to the discussion. Here you see the shares are purchased at very high value when the growth potential is high for the startups. In between, some income tax official will come and he will calculate fair market value, and fair market value is calculated by using some traditional calculation methods, right? And by using some traditional calculation methods, this fair market value of each share that will be calculated. But here investor purchased it at a high value, very high value, because of the growth potential of the startup company. So under these circumstances, what the income tax department is doing here, above this, the difference between their calculated value and the purchase value by the investor who is investing in the startup, that is considered as income, and it is taxed at around 30%. Government is doing this basically to prevent money laundering. But how is it affecting startups? Startups are saying because of this mechanism, their growth potential is affected, their funding is affected. So now to strike a balance, government came up with via media mechanism, and these are the rules and regulations. That means here the startup period increased to 10 years. Within this period, the turnover of the startup should not exceed rupees 100 crores, and at the same time there is no angel tax up to rupees 25 crore. Then investments made by a listed company, that means if the company is listed with net worth of at least 100 crore or a turnover of at least 250 crore, there is no angel tax. Very important. So if the investment into the startup is from a big company, which is a listed company, then there is no angel tax. At the same time, investments made by non-residents, no angel tax, right? So friends, these are the conditions. I hope now you got the point. Let us move on to the next one. Monetary policy is often into focus, and Monetary Policy Committee, 3+3. 3 from Reserve Bank of India, 3 external members, that constitutes Monetary Policy Committee. And for the external members, the selection committee of this Monetary Policy Committee members is headed by the Cabinet Secretary, very important. So Cabinet Secretary heads the selection committee of MPC members. Please don't forget, 3 from RBI, 3 external members. And one more important aspect is RBI Act was amended in 2016 and a new chapter on monetary policy was introduced. And please don't forget, as per this, the committee constitutes 3+3, 3 external members. And here, if there is a tie for taking a decision, that means 3 persons said yes, 3 persons said no. Under those circumstances, final decision rests with Reserve Bank of India Governor, very important. So the casting vote is with Reserve Bank of India Governor, 3+3 are the members. And the next important aspect is how the inflation target is fixed. And please don't forget, the inflation used in giving the target is consumer price index based inflation. So friends, CPI inflation Reserve Bank of India considers. Second important point, the inflation target. That means when the Monetary Policy Committee is deciding about money circulation and other aspects, then there is one mandate given by the government. The mandate, that means central government, in consultation with Reserve Bank of India, they give inflation target based on CPI inflation, and it is for 5-year period. At present, for the 5-year period, the inflation target based on CPI is 4% plus or minus 2%. Right? So this point is very important. This point is also very important, and the Monetary Policy Committee shall determine policy rate. That means, for example, repo rate. It will take decision with regard to repo rate based on inflation. And please don't forget, there may be a typical question with regard to what is the primary objective of Monetary Policy Committee. Monetary Policy Committee primary objective is to maintain price stability, or you can say to look at inflation. The inflation is to be kept within the range of 4% plus or minus 2%, or you can say it is to maintain price stability. And one more addition is there, please don't forget. What is this addition? While keeping in mind the objective of growth. So please read this sentence. Sometimes a critical question may be asked in the prelims. So the main objective of the monetary policy is to maintain price stability, no doubt about it. But there is some addition is also there, that means keeping in mind the objective of growth, right? This is more than enough on the Monetary Policy Committee constitution. What is the mandate given by the government in consultation with RBI, and which type of inflation it takes into account? What is the mandate given to the Monetary Policy Committee? I hope you got the point. And the Monetary Policy Committee sets the repo rate, right? Quite often you talk about repo rate. Repo rate is the policy rate, or you can say it gives direction to the country with regard to interest rate structure, right? So once the repo rate is reduced, then the Reserve Bank of India expects the interest rate in the country will reduce. That is known as monetary transmission. And as the Reserve Bank of India felt that monetary transmission is not taking place, because of that reason, for some of the loans, it is said, please look at external benchmark. Don't keep your MCLR for the retail loans as well as micro and small enterprises loans. That is how the external benchmark mechanism came. Because the external benchmark mechanism for the loans came because of the directive of the Reserve Bank of India, keeping in mind monetary transmission is not taking place properly, right? Then the recent monetary policy. Here please don't forget, I would like to explain you about what is neutral, what is calibrated tightening. Previously it was calibrated tightening. Now it is changed to neutral. And what do you understand by these two terms? One is a neutral policy stance. In the monetary policy, in the newspapers, you come across neutral policy and calibrated tightening. What is the difference? When you look at neutral, that means the meaning of neutral is as you go forward in future, the interest rate structure may be kept as it is, or it may be reduced, or it may be increased. That means here in future the aspect is there is three-way possibility. If you look at repo rate and the meaning I have given here, neutral monetary policy is neither expansionary nor contractionary, right? So this is the important point, and that indicates in future going forward the Monetary Policy Committee may look at three options. That means there is status quo, there is no interest rate cut, there is no interest increase, and the second case is repo rate increase, third case is repo rate decrease, So therefore, three options are possible in the neutral policy stance. And if you look at calibrated tightening, that means out of the three options, rate cut is ruled out. As you go forward, it may be status quo or increase in the repo rate. That is known as this calibrated tightening. That means here calibrated tightening means rate cut is off the table. That means as you go forward, there are only two options. That means monetary policy committee may increase the rate or keep them steady. Right friends, this is the difference between neutral monetary policy stance and calibrated tightening. Right now the policy stance is changed from calibrated tightening to neutral. Right, in this context these words are important. Friends, two important decisions in recent times, and the other decision which we have seen in the previous classes, the statutory liquidity ratio SLR, that is being cut every quarter 0.25%. That is one important decision which was taken during the year. So SLR will gradually reduce from 19.5% to 18% within the span of 6 quarters. So friends, within the span of 6 quarters, the statutory liquidity ratio will be cut from 19.5% to 18%, and every quarter 0.25% reduction. Then second important aspect, please don't forget, which emanated after the Monetary Policy Committee meeting and decided by Reserve Bank of India, is collateral free farm loan limit. Very important. Collateral free loans for the agriculture sector. Here this is increased to 1.6 lakh rupees from rupees 1 lakh. Collateral free loans, in fact without any collateral security. Banks will give loans without any security. So this is collateral free agricultural loans, and these are increased from rupees 1 lakh to rupees 1.6 lakh. Please don't forget. This is one important development. Second one is deposits over rupees 2 crore will be defined as bulk deposits. Previously, deposits over rupees 1 crore were defined as bulk deposits. That means for the bulk deposits, the banks may have different interest rate structure. Right friends? So bulk deposits, they are above rupees 2 crore. Right? And below that, they will be retail deposits. Previously, below 1 crore, retail deposits, above 1 crore, bulk deposits. Now this is changed to rupees 2 crore, very important. Right? Another important aspect is with regard to monetary transmission. I already told you, for the retail loans as well as for micro and small enterprises loans, from April 1, the Reserve Bank of India gave instructions. The floating rate interest loans, or you can say floating loans or floating rate interest loans, they should be based on some external benchmark. 4 options are given, right? So external benchmark is in fact the decision based on improper monetary transmission. At present, the loans are based on MCLR, and please don't forget, marginal cost of funds based lending rate, that is decided internally by the bank. And because of that, the Reserve Bank of India feels monetary transmission is not taking place. So therefore, Reserve Bank of India gave the instruction that in future for some loans like retail loans and loans of micro and small enterprises, that means loans like personal loans, house loans, mortgage loans, then micro and small enterprises loans, they will be tagged to some external benchmark from April 1. That is to ensure monetary transmission. Right friends? Look at the next one. This is with regard to the norms for some NBFCs are eased. More than that, what I would like to tell you is one important word, risk weight. That means each and every loan in the banking system will have some risk weight. When the risk weight is less in the banking system, provisioning is less. What is provisioning? Provisioning is the money which is required to be set aside by the banks to take care of future losses, and that depends on risk weight, right? So the house loan may have less risk in comparison to personal loans. So therefore, the house loans will have less risk weight in comparison to personal loans. So friends, please don't forget risk weight and provisioning. These words are very important. So provisioning means the money which is required to be set aside by the banks with regard to the loans. And please don't forget, once the loan becomes bad, then provisioning increases. In recent times, you come across the news items that because of the higher provisioning, banks are into losses, right? So this is very important. Because of higher provisioning, banks are into losses. And please don't forget, banks have to keep set aside some money based on risk weight. And if the risk of the loan is high, provisioning will be high. This is one important aspect. And the second important aspect is, as the loan becomes bad, the provisioning increases. And because of that, recent times, several public sector banks reported losses. Right, friends? This type of analogy must be inbuilt in your mind. They are very important from your prelims perspective. Right, friends? Next news item. This is Union Cabinet approved rupees 1450 crore for the share capital of RBI in the National Housing Bank. And if you go back 10 years, 10 to 12 years, the share of Reserve Bank of India in State Bank of India was given to the Government of India. Similarly, the share of Reserve Bank of India in NABARD was given to Government of India. That means at present, there is no shareholding of Reserve Bank of India in State Bank of India as well as NABARD. And on similar lines, the wholly owned subsidiary of Reserve Bank of India, that is National Housing Bank, is going to be owned by Government of India. That means the entire shareholding of this National Housing Bank will go from RBI to Government of India. This is the important development. What is National Housing Bank? National Housing Bank is All India Financial Institution, and it is set up through an act of Parliament. Basically, it looks at housing finance companies, very, very important. So, the shareholding now will be held by the central government. The RBI's shareholding will go to the central government. Why? Why this decision? This decision is basically to segregate the role of Reserve Bank of India as the regulator, and at present it is regulating banking institutions. At the same time, it is having ownership in National Housing Bank, and to segregate the Reserve Bank of India's role as the banking regulator, this decision is taken. Right, friends? Next important news item. This is about Affordable Housing Fund. The fund is required, that is Affordable Housing Fund. That means to support affordable houses. And here, why this is required? This is required because the center is giving this credit linked subsidy scheme, or popularly known as CLSS. What is this CLSS? That means when you belong to economically weaker sections or low income group or middle income group, that means if you belongs to economically weaker sections, it depends on your annual income. That means the categorization of economically weaker sections, low income group, middle income group, that depends on your annual income. So friends, when you belong to EWS, when you belong to LIG, when you belong to MIG, when you are constructing a new house or when you are purchasing a new house, then when you take loan, central government is giving subsidy on the interest, right? So that interest depends upon whether you belong to economically weaker sections, LIG, MIG1, MIG2, and here the center is giving interest subsidy. So that is a credit linked subsidy scheme, or CLSS. That means when you are accessing bank loan or when you are accessing loan from any other non-banking financial company, then here the credit linked subsidy scheme will be applicable. That means when you are purchasing some affordable house, then some interest subsidy is given by the center. Basically, this is to promote housing for all by 2022, and for this credit linked subsidy scheme for affordable houses, money is required, and that money is affordable housing fund, and this is maintained by National Housing Bank. Please don't forget, we talked about National Housing Bank till now. So National Housing Bank manages affordable housing fund, and please don't forget how the money comes. The money to this fund comes from priority sector lending shortfalls. All of you are familiar in the banking system. 40% of the loans, with some exceptions, they have to go to this priority sector lending. So friends, when banks fail to provide 40% loans to priority sector, then the shortfall is to be deposited somewhere. And one such mechanism is this affordable housing fund. So friends, banks in the priority sector lending shortfall have to deposit some of the money with the affordable housing fund. Or second channel is, that is first channel. Second channel is fully serviced bonds. National Housing Bank can release fully serviced bonds. What is the meaning of fully serviced bonds? Fully serviced bonds means the principal and interest, they are fully financed by the Government of India through the budgetary provisions in the demands for grants. That means when the National Housing Bank is issuing this fully serviced bonds, the principal repayment, the interest repayment, they are all fully taken care of in the budget. That means they are financed by the Government of India. So they are known as fully serviced bonds. So friends, affordable housing fund money is coming from the shortfalls in the priority sector lending, and it is through issue of fully serviced bonds authorized by the central government, right? And please don't forget, they cater to both the housing finance companies and banks. Very, very important. So they correspond to both housing finance companies and banks. So friends, this affordable housing fund, this is meant not only for the banks as well as housing finance companies, and how the money is coming I explained here, and it is applicable for both housing finance companies and banks as long as they are financing affordable housing to economically weaker sections, low income group, middle income groups. Right friends, I explained you about credit linked subsidy scheme also. Right friends, look at the next one. In a first of its kind, State Bank of India decided to link interest rate paid on savings bank balance of over rupees 1 lakh to the repo rate. And at the same time, I explained you a short while ago, as far as the loans are concerned, loans in the retail sector like mortgage loans, like house loans, like personal loans, right? So all these retail loans as well as the loans to micro and small enterprises, they will be tagged to external benchmark. 4 options are given from April 1. That is one news item, please don't forget. And if you look at the banking sector, another important aspect is State Bank of India decided to link the interest rate on the savings bank accounts. That means this is applicable for over rupees 1 lakh. That means if you are having 1.5 lakh deposit, what is the interest? Interest is 3.5%. And what is present repo rate? 6.25%. That means it is lesser than the repo rate by 2.75%. So friends, in future, if this repo rate becomes 6%, then your interest rate will become 3.25%. And tomorrow, if repo rate becomes 5%, your interest rate will become 2.25%. Similarly, if repo rate becomes maybe 10%, then your interest rate will be 7.25%. So it is tagged to this repo rate. right? And here cash credit accounts and overdrafts above rupees 1 lakh, they will also be tagged to the repo rate, please don't forget, right friends? This is some sort of tagging to some external indices, right friends? This is about diesel and petrol. Why I have taken this is there is huge tax collection on diesel and petrol, not only by the center but also by the states, please don't forget. And have a glance at it. This is the average crude price. This line shows average crude price and this line shows average petrol price. So please keep in mind this one. Though the average crude prices have fallen, but petrol price in fact has not fallen, it increased, or you can say it was almost at the same level during the past 3-4 years, you can say, right? So the important point to note, this slide was taken pertaining to around 3-4 months back, and now there may be slight change, please ignore it. And why I have taken this slide is basically to explain you what is going on in petrol and diesel as far as crude price is concerned. Just have a glance at this. And here where your money goes, if you take the petrol as well as diesel, this slide I have taken only to explain you what percentage is central taxes, what percentage is state taxes. In recent times, center imposed huge excise duty during the past 3-4 years. That's what I would like to convey. And of course, there is a slight reduction in recent times. And broadly, please remember the taxes of center and states, they constitute substantial amount as far as petrol and diesel are concerned. Only to explain you, I have taken this slide, and these figures might have changed by this time. So please don't give that much credence to the figures, but you understand the logic of these two slides, right? This is a crude price that has fallen, but petroleum price has not fallen. Why? Because the center imposed the excise duty, or you can say increased number of times. Of course, in recent times it reduced slightly. And please have a glance at how the state taxes, central taxes are contributing to the overall petrol and diesel prices. Then the next one here, petroleum products. There are number of taxes on petroleum products, not only direct diesel and petrol, and please have a glance at it. And one important aspect, what is within GST, what is outside GST? This is very, very important. So what are the components within GST? What are the components outside GST? And please don't forget, this is important from your examination perspective. LPG, kerosene, then this naphtha, these are all in fact GST covered. But when you look at crude oil, when you look at diesel, when you look at petrol, these are not covered under GST. When they are not covered under GST, what happens? I told you previously, this results into embedded taxes. That means it facilitates, or you can say it results into loss of competitiveness, right? So embedded taxes is very important. When something is not into the GST framework, then you don't get input tax credit. So when you don't get input tax credit, then the cost of the ultimate product will increase. So these are examples of embedded taxes. So therefore people say there is an urgent need to bring them under the GST fold. Right friends? Then please look at it. 2-3 important points. Kerosene and LPG prices are regulated by the government. That means on diesel, petrol, there is no subsidy. And when one looks at kerosene and LPG, there is a subsidy, and the prices are administered, or you can say regulated by the government. Right friends? This is with regard to the rupee dollar trajectory during the past 25 years. Around 25 years ago, it was 31 rupees per dollar. Now it is around 70 rupees per dollar. this is the trajectory. Sometimes slight appreciation, most of the times in general there is depreciation, right? And what are the reasons? I am looking at long-term reasons. There may be short-term reasons, but I am ignoring them because of the reason these short-term reasons might have changed by this time, because I have taken this slide belongs to around 5-6 months ago. So long-term reasons, have a glance at it. First and the foremost is historically India's imports are more than India's exports, right? And the next important aspect is we are not able to promote exports in a big way. Then second important aspect is we are unable to reduce dependence on the oil imports. Still our 80% of requirements are met through imports. Then import of electronic goods is increasing in recent times, and we are not able to control non-essential gold. Then one more important aspect is high inflation in comparison to advanced countries. That means inflation in developing countries is normally higher than the inflation in advanced countries, and because of this, that means as the inflation is high in a country like India, naturally depreciation of currency happens. It is a natural process. Then the dependency on FPI, FDI flows, as and when we get more FPI flows, more FDI flows, then what happens? This rupee appreciation takes place sometimes. And in general, there is rupee depreciation because of all these elements. So the important aspect is we have to promote exports in a big way. We have to reduce our dependence on import of oil at least by 10% as promised by the Prime Minister. And there are of course some short-term reasons. Sometimes I am not going into them. And BSc Dolex students should have clear idea about Sensex. Dolex. What is Sensex? That is some index of some 30 companies or so. So BSc Sensex, all of you are familiar with. And what is Dolex? Dolex is when you convert this into dollar terms. So friends, when rupee depreciation is there, very important. When rupee depreciation is there, then this BSc Dolex, or you can say dollar index, that lags behind Sensex. So Sensex will be higher than Dolex when there is rupee depreciation. When there is rupee appreciation, this Dolex will be higher than Sensex. Right friends, this is more than enough. And finally, before concluding this lecture, when rupee depreciates, who are the beneficiaries? Who are the losers? Here when rupee depreciates, the beneficiaries are exporters, no doubt. Because when rupee depreciates, they get more rupees when they sell the product in America or in European country. Then Indian multinational companies which have their operations abroad, they will be benefited. Software sector will be benefited, and foreign remittances. When the son is sending money to the father, then if rupee depreciates, father will get more number of rupees per each dollar. Then losers, oil, that becomes costlier. Then corporates will be affected because several corporates are in fact importing capital goods. One more important aspect is foreign portfolio investors will be affected because they get less number of dollars when the rupee depreciates. Then here foreign tours will become costlier because of depreciation of currency. Then the companies which have outstanding debt in foreign currency, that means please recollect external commercial borrowing, when they hedge against the risk, there is no problem. But most of the external commercial borrowings are without hedging. So when the external commercial borrowings are without hedging, then what happens? The external borrowings corporates, that means the corporates whoever borrowed from abroad, they will be affected when rupee depreciates. And please don't forget, if Indian corporates are raising money through masala bonds, Masala bonds are nothing but rupee denominated bonds, then they will not be affected by currency appreciation or currency depreciation. When they are borrowing in dollar terms from abroad without hedging, they will be affected. And when they are raising money through the masala bonds, they will not be affected. Right friends, this concludes this economy lecture. This is economy lecture number 4 and current affairs module number 18. Have a nice day. Thank you.